Russia-Ukraine standoff and its impact on Indian economy. Is Indian economy is fully insulated in this entire geopolitical crisis? What are the factors that are going to get impact on Indian economy? What will be the impact on interest rate? What is China plus one strategy? Hi everybody. In today's episode we are going to discuss what is the impact of Russia-Ukraine war in Indian economy. So let's get started. Even before the Russia attacked Ukraine, the global economy was struggling due to surging inflation, tangled supply chain and tumbling stock price. The war has just magnified these problems and delayed the possible solution. One good thing is that neither Russia nor Ukraine is an economic powerhouse. The combined export of Russia and Ukraine is less than 2% of the world's GDP, and most of the major economies has limited trade exposure with Russia. For example, US, it is just 0.5% of its overall trade, and hence overall impact of the war in global economic and financial market to a certain extent can be quantified. European economy remains to be the most fragile and vulnerable economy in the entire geopolitical crisis because Europe is importing 40% of its natural gas and 20% of its oil from Russia. Hence, the war is going to have a significant impact on European economy. War will magnify the likelihood of higher inflation and other economic setback for European continent. What will be the impact on Indian economy? India is not fully insulated in this entire geopolitical crisis. Despite India has very low share of trade with Russia, Indian economy or India need to be watchful of two things. One, surging crude price. Since India is highly dependent on import of oil for its energy needs, any significant increase in crude price will have a severe economic impact for Indian economic point of view. The second is the global market volatility. The global market volatility will have a spillover effect in Indian economy. US and other Western countries have imposed economic sanctions of unprecedented breadth on Russia, and that has disturbed the balance of demand and supply equation globally. It will lead to a higher commodity price. Higher commodity price is here to stay for a longer period of time even if the war de-escalates today. So the exporter of commodity are the beneficiary and the importers of commodity are going to face the hardship. What would be the impact on inflation? Since the crude and the commodity price are on the rise, so the inflation is bound to rise and pose a serious risk to inflation print globally, which is already running high at a record level for US, Germany and UK. In India, the rising inflation is likely to impact Indian urban poor and the rural the hardest. However, inflation can still remain lower than the historical trend. 86% of India's CPI is core and food. Unlike 2012 to 2014, this time inflation is going to be lower because of the lower core and food inflation. It may remain 6% and less for the next fiscal year provided the crude remain below $90 per barrel for FY23. Now the big question is, what will be the impact on interest rate? Interest rate hike by Fed was imminent. The Fed on Wednesday lifted its key interest rate by quarter of percentage point and projected six more increase this year to combat the inflation which was at 40 years high. The action of Fed will put pressure on emerging market central bank to raise the interest rate. But the question is RBI is going to also come under pressure due to the action by Fed? We don't think so. India is in a very sweet spot, and hence RBI is likely to stick to pro-growth strategy. So the scope of repo rate hike may be limited to 75 to 100 basis points in the next financial year. Will the selling of FIIs will be continued in the next financial year as well? India remains a good house in the bad neighborhoods. After China tech crackdown and Russia-Ukraine conflict, FIIs are mindful about investing in developing market, and hence we can expect FII selling to be continued in coming days as well. However, India will still be a hot destination for FIIs as it is better placed than fiscal 2013 to withstand any external shocks and remain stable and one of the fast growing emerging market. Post US rate hike, if there is any slowdown in the growth combined with twin deficit, FIIs trend will reverse. Now, what are the factors that are going to play a key role in India's stable and the fast growth? The structural reforms and Atmanirbhar Bharat will play a key role for India's stable and the fast growth. Capex over OPEX. India has realized that the dependency on oil for its 85% of the requirement is a sign of worry. Hence, government is expediting work towards ethanol blending, green energies and hydrogen gas policy. In short, focus will be on the capital expenditure to build alternative channel for crude over OPEX, means subsidy on kerosene, LPG, etc. Now, what is the second most important factor? It is China plus one strategy. What does it mean? And how India is going to get benefited out of China plus one strategy? China is called world's factory and it has been the center of the global supply chain. Data suggests that 30 to 35% of the global manufacturing happens in China because of the conducive manufacturing and the strong business ecosystem. China was rising as a global manufacturing hub since early 2000 from mere share of 3.4% to 13.6% in 2015 till it fell to 13.1% in 2019. In 2017, China adopted strict environmental norms, leading to a production cut in the winter, followed by trade war and change in geopolitics. Hence, large companies, MNCs, they started contemplating to diversify the dependency on China by adding new operations on the other developing Asian countries like India, Bangladesh and Vietnam. This strategy is called China plus one strategy. India is under the sweet spot due to the various schemes such as Performance Linked Incentive Scheme (PLI), Import Substitution Schemes, Make in India schemes. So the sectors like specialty chemicals, pharmaceuticals, textiles, metals, electronic goods is going to be the most benefited sector out of China plus one strategy. The third and the important is Atmanirbhar Bharat. India is a domestic consumer economy and it is neither a large importer nor a large exporter. Hence, India may not be fully but partially insulated from the external shocks like Russia-Ukraine conflict. In terms of food production, apart from the oil shales, India has achieved self-sufficiency. What does it mean? It means that India may not be dependent on the other countries for the food. In fact, in the future, India could be the big exporter of food. India's consumption has only 12% of imports mix, whereas US has 37% of import mix. Now the fourth and the most important point is India's foreign policy, India's foreign diplomacy. India's relationship with the foreign countries has strengthened in the last 7 to 8 years because of its strong foreign policy and the strong foreign diplomacy. Vasudeva Kutumbakam is India's philosophy, which means world is one family. India believes in creating an ecosystem where everyone grows together. The famous tagline of the current government is Sabka Saath, Sabka Vikas, Sabka Vishwas. It is not for only meant for Indian citizen or Indian voter, but in fact it has been reflected in India's foreign diplomacy, be it vaccine method, neighborhood first policy. India's strong foreign policy has created a ripple effect across the globe, and India is very well placed in the global stage. India is getting benefited out of TINA factor, which is called there is no other alternative than India. And the factor which is going to play important or key role as discussed, China plus one strategy, Atmanirbhar Bharat, self-sufficiency, capex over opex. India is one of the stable and the fast growing economy amongst the emerging market. Hence, FIIs trends are bound to reverse and the money is going to chase back to equity market. So, play for India, invest in India. That's all from today's episode. If you like my video, please hit the like button, subscribe to my channel, do support us. Jai Hind, Jai Bharat.